Hello, and welcome to Investment Insight, your clear take on the markets. Let's get started. Today, we are diving into, well, a trio of really high-stakes stories. They show exactly where global capital is heading, pushed by policy, innovation, and sometimes hidden risk.
That's right. Big forces at play.
We're tracking this huge shift in China overtaking Japan in the ETF space. Then there's the AI chip race. It's white hot, and a giant seems to be staging a comeback.
The semiconductor marathon?
And finally, Jamie Dimon. He's put out this really urgent warning about cockroaches hiding deep inside the credit system.
Yeah, quite a mix. But they're more connected than they seem. Our job today is to cut through the noise, pull out the crucial bits, the actionable stuff.
The meaning behind the headlines.
Yeah, exactly. And these are complex shifts, right? Geopolitics, tech, systemic risk. So we'll use some clear analogies. We want you to walk away not just with facts, but really understanding what it means for, your own thinking.
Okay, let's unpack the first one then. This historic reversal in Asia. Our sources confirm it. China has officially leapfrogged Japan, biggest ETF market in Asia.
First time ever.
Yeah, China mainland ETFs hit, what, $450 billion in assets under management? That's AUM. As of September 2025, just edged out Japan's $420 billion.
And it happened fast, not a slow creep.
So what caused that? Such a rapid jump.
Well, the key word here is policy. It's emphatically not about organic investor demand flooding in.
Not just regular folks buying ETF.
No, not primarily. This milestone is basically being engineered by the national team.
Okay, the national team. State money we're talking.
Precisely. State-owned investment groups, Central Huijin is the big one. They're pouring absolutely massive targeted amounts of cash into their own stock market. Why? To ensure stability.
How massive are we talking? Give us a sense of the scale here.
Think financial artillery. Sources estimate something like 80% of China's recent ETF growth. It comes directly from the state buying.
80%.
Yeah. And the number. An estimated $55 billion just in Q3 2025. Poured into large-cap index funds.
$55 billion
Right.
in one quarter, just into the CSI 300 and Shanghai 50.
That's right. The main blue-chip indexes, they're basically putting a floor under the market.
Wow. Okay, put that next to Japan. What's happening there?
It's the complete opposite story. The Bank of Japan, the BOJ, they used to be the world's biggest ETF buyer, remember, buying up market risk for years.
Right. They were a huge player.
That era, it's over. The BOJ stopped all new ETF purchases back in late 2024, and now they're actually planning a gradual sale of the huge pile they already own.
So the biggest buyer is turning into a potential seller.
Exactly. While in China, the national team is becoming this just dominant force. Massive intervention versus planned exit.
That contrast is stark. But, okay, this artificial growth in China, what does it mean for managing risk? If it's not real growth, just policy, how sustainable is that, even for China?
That brings us right to this critical idea, the Huijin Put.
The Huijin Put. Okay.
Yeah. The sheer amount of money they're throwing at it shows the government's political will. They really want to prevent a market collapse. So short term, this creates a powerful policy-driven support line under the index.
Like a safety net.
A huge one. Think of it like this. It's as if the government placed a massive, invisible safety trampoline under the main stock market index.
Okay, a trampoline, I get it.
They're signaling, very loudly, we will not tolerate a major price drop right now. So for you, the investor, the actionable insight is this. You have to watch the national team's money flows.
Their movements and policy signals.
Yes, they become the most important barometer for short-term direction. More important, arguably, than traditional economic data right now.
That makes sense. Sort of tactically rational, maybe. But the underlying risk sounds, well, terrifying. How do you play this artificial party without getting totally burned when they decide to, take the trampoline away?
The trade might seem rational short-term, but the risk is absolutely profound because the trampoline, it supports the price, right? But it doesn't fix the underlying economic issues that caused the slump to begin with.
Right. It doesn't solve the real problem.
Exactly. So if the government runs out of money, or maybe just political will, the correction, when it comes, could be much, much deeper. You absolutely need an exit strategy, always.
And it creates distortions, too, doesn't it?
Huge distortions. Extreme market polarization, the big state bad companies, they get all the support. But the smaller, more entrepreneurial mid-cap firms, they get neglected. Low liquidity, struggling.
And Japan, the contrast is that the BOJ stepping back actually means normalization.
That's the beauty of it, potentially.
Yeah.
Japan's market is moving away from being driven by this huge government whale, the BOJ. It's shifting towards, well, fundamentals, corporate earnings, shareholder value.
More like a Western market model.
Exactly. Which suggests that long-term value investing, focusing on things like governance and dividends, it's finally becoming really viable, maybe even strategically important, in Japan again.
Fascinating contrast. Okay, so state intervention twisting capital flows in Asia, but money is also pouring globally because of, well, pure market hunger for AI. Let's shift gears. The AI chip marathon.
Right. The supply chain's underpinning everything.
Yeah. And for a long time, SK Hynix was the king of high-end memory, HBM. But our sources are saying Samsung is making a huge comeback, a definitive one.
They absolutely are. And this comeback, it's directly linked to NVIDIA. The gatekeeper. They control, what, 90% of the AI hardware market?
Still the dominant player.
Hugely. So after several tries, several frustrating attempts, Samsung finally passed NVIDIA's crucial final quality certification. This was for their 12-layer HBM3E product, just in September 2025.
That certification, it's more than just a supply deal, isn't it? It's like a stamp of approval, technical validation.
It's both symbolic and very material. The immediate effect. Look at the scoreboard. Samsung jumped back to the #1 spot in the global memory market in Q3 2025.
Beat SK Hynix in revenue.
Yep. And analysts explicitly said it was because of strengthened HBM competitiveness. Samsung's officially back in the race as an equal player.
Okay, so equal players. But is this HBM competition more like a quick sprint, or is it a marathon? And looking ahead, say to the next generation, HBM4, does Samsung have some kind of structural edge?
Oh, it's absolutely a marathon. And yes, the structural advantage is potentially huge for Samsung. Their secret weapon, it's not just their memory tech itself, it's vertical integration.
Meaning they make everything themselves.
Pretty much. They own the world's #1 memory business and the world's #2 foundry business, the chip-making factories.
Okay, break that down. How does owning both help with HBM specifically?
Right, let's use an analogy. HBM, high bandwidth memory, it combines two key parts. You've got the stack of memory chips, the DRAM, and then you have a sort of brain underneath the logic die that controls how the data flows.
Memory and a controller.
Exactly. Now, SK Hynix, they make the memory great, but they have to outsource the production of that brain, that logic die, usually to a foundry like TSMC.
Okay.
Samsung, though, they can design and manufacture that optimized brain internally using their own advanced 4-nanometer foundry process.
Ah, so they control the whole package.
Precisely. Does that guarantee victory? No.
Yeah.
But does it give them a massive advantage? Absolutely. They can fine-tune everything together. Cost, power efficiency, performance, and crucially, supply stability.
That supply stability must be huge, especially now.
It gives them huge leverage. And they're pushing hard for the next round, HBM4. Talk about ultra difference with next-gen tech like hybrid bonding. Their ability to optimize both memory and logic all under their own roof. It gives them technical flexibility competitors just don't have.
What's also interesting here, Samsung isn't putting all their eggs in the NVIDIA basket, even after getting that certification.
That's smart risk management and key to their long-term picture. They now have two powerful engines. Yes, they supply NVIDIA now, but they were already the near-exclusive supplier of this 12-layer HBM3E to AMD.
NVIDIA's main competitor.
Right. So as the AI chip market hopefully shifts from just an NVIDIA near monopoly towards more of a duopoly with AMD gaining ground.
Samsung wins either way, or at least has a steadier ride.
A much more stable, diversified growth structure.
Yeah.
It doesn't matter quite as much which AI giant wins the next round of market share. They're positioned well.
That is a powerful position. Okay, let's pivot to our final topic, the view from Wall Street, which sounds, well, a lot less optimistic. Jamie Dimon, CEO of JP Morgan, he's warning that great bank earnings are actually masking deeper credit problems. What's this cockroach analogy he used? Sounds chilling.
It is a bit chilling, isn't it?
Yeah.
The analogy is pretty simple, though. If you see one cockroach in your kitchen, chances are there are hundreds more hiding behind the walls, right?
You never just see one.
Okay. So Dimon is saying, stop looking at individual failures like one company going bankrupt or one stock tanking as isolated events. You need to start actively looking around the corners. Look for the systemic issues that haven't quite crawled out into the open, into the transparent public markets yet.
Okay, so where are these potential cockroaches hiding? What are the dark corners we should be watching?
Well, our sources point to two major habitats that Dimon seems to be hinting at. Habitat #1, the shadow market. specifically things like business development companies, BDCs, and the broader private credit market.
BDCs, those are the firms that lend to mid-sized companies, kind of like banks, but less regulated.
Exactly. Shadow banks, essentially. And here's the signal. BDC stocks, names like Ares Capital, for example, they've recently plunged, maybe 10–15%. And they're trading at a really deep discount to their net asset value, their NAV. We're talking 20–30% below NAV.
And NAV is what the loans are supposedly worth on paper.
Right. It's the book estimate of the value of the loans they hold. So when this stock trades way below that book value, it means the market is pricing in significant loan failures. Problems the company itself hasn't officially admitted to or written down yet.
That's the first cockroach scuttling out.
That's a strong signal, yes. Yeah. Habitat #2 is commercial real estate, CRE. We just saw a big flare up here. Blackstone's major non-listed CRE fund, Bright. It had to restrict investor redemptions.
Meaning people couldn't get their money out.
Exactly. They were hit by a massive wave of investors wanting to withdraw their cash. It shows the sector, already struggling with high rates and office vacancies, is now facing severe liquidity risk.
They can't sell the buildings fast enough to pay back investors.
Precisely. The value might be dropping, but the bigger immediate problem is you just can't get out. That's terrifying for investors.
Absolutely. So if Jamie Dimon, the Emperor of Wall Street, is worried, how should you, the listener, maybe stress test your own portfolio against this kind of hidden risk?
The stress test really starts with one word: transparency. Ask yourself two key questions about the companies you're invested in. First, how much debt do they have?
Okay, leverage levels.
Second, and maybe more crucial right now, where did they borrow that money from? Was it a regular, transparent, highly regulated bank? Or did it come from one of these opaque private credit funds, a BDC?
Find out who the lender is.
Yes. And if you find exposure to that opaque private market, well, transparency is safety right now. The advice would be to really emphasize avoiding those private markets. BDCs, non-listed private funds, the Blackstone Bright situation, textbook liquidity risk.
You might be locked in when you need the money most.
You might. Stick to highly transparent public markets where you can see the price second by second and you know you can trade.
Makes sense. What else?
Focus ruthlessly on quality. In any kind of credit crunch or crisis, it's the quality companies that win.
Meaning low debt, lots of cash.
Exactly. Low debt ratios, high cash reserves, they can weather the storm. And more than that, they can actually gain market share from competitors who are over-leveraged and get crushed by rising interest costs or tighter credit. Quality wins.
Okay, let's try and summarize this deep dive then. We saw policy creating this massive kind of artificial stability in China, but with maybe artificial risks growing underneath.
The Huijin Put.
Then structural advantages driving this really intense competition in the AI chip market, the HBM space.
Samsung's vertical integration edge.
And meanwhile, maybe the biggest, most immediate risk for everyone is lurking in those less transparent, opaque corners of the credit system.
That sums it up perfectly. And maybe here's a final provocative thought to leave with you. China's relying on artificial boosts, right? The U.S. credit system is flashing these red warnings from the shadow markets.
Yeah.
Maybe the true long-term stability and the real opportunity actually lies in the Japanese market now.
Because the BOJ is stepping away.
Precisely. It's returning to a normal system, driven by corporate fundamentals, shareholder value, finally free from that massive government whale distorting everything, that normalization process. It just might make Japan the safest, most fundamentally sound bet for the next decade. Something to think about.
That is a fascinating place to look for value, away from the current headlines. Great insights. Don't forget to subscribe and hit that like button.